Welcome back to Primary Source China Investment. This week we're on show J4. And for those of you celebrating the Lunar New Year, happy Year of the Rabbit. Peng Guo and I are ready to get into it this week. And we're talking about something that is not as popular as the equity market, but maybe more important, which is the fixed income market and foreign exchange. So as we discussed last week, China came out after the lockdown of COVID and in the new year, and equity markets jumped. What we didn't cover was the fixed income market and the foreign exchange market, which is bigger and probably less sexy. After spending 3/4 of 2022 depreciating against the US dollar by almost 15%, a massive move and killing US dollar investors in the process, things have absolutely turned around. Since Q4 of 2022, renminbi has appreciated halfway back. And while Peng Guo and I aren't chartists here, the level of about 678 against the dollar is the midpoint of the last 5 years. Appreciating renminbi does affect exports, and China is still an export economy. So perhaps Beijing is banking on the reopening and consumption to lead the economy forward. I am not so confident of that as I'm looking at the consumer confidence numbers, and that's the chart I'm going to be looking at in the next few months. What's your thoughts there, Peng Guo?
I think you are right. Firstly, happy Chinese New Year, and I hope everybody enjoy it. It's really changed from the COVID, all kind of the COVID-related work to improve the economy, because an individual company as well as the country, they suffer a huge loss during the COVID period. I think a lot of the things could turn to positive right now, especially like the domestic consumption had improved, and which also improved many companies' revenues and expectations. So you will see the stock market is really turning up right now after China open doors policies. I think the micro factors are still the major impact for the investment business, especially like the exchange rate as well as the rate. So those interests also include the United States Federal Reserve's interest rate as well as expectations. You can see the China investor talks a lot about the rate as well as the those expectations on the different sectors. So that's really the fundamental to affect the valuations of many companies. And
yeah, your point about the rate, just to give viewers a number here. 10-year rate in the US is now 345. 10-year rate in China is 296. So you're actually getting more return in US dollar. So US dollar investor is probably looking at China fixed income with a lot less enthusiasm than they once had.
Thank you for that. I think for the overall, the China bond market are relatively stable. We know that we talk about the corporate bond, they have the lot of the problems with the real estate business, but it looks like the potential problem should be the muni bond, and after that, I bet probably the fixed income market should be quite stable. And I would expect that people solve this problem. They cannot solve it one by one. They have to solve it with the development of the country, of the entire economy. That's their strategies. They cannot stop and to fix the areas and then go back to improve the economy. So they have I think that the strategy is different.
One of the things I went back to look at is exactly on this. We talked about C-bond a lot last year. We talk about C-bond because it's really only the one real way for foreign investors to get access to renminbi-denominated fixed income. And it had a bad year last year. But if you pull out the chart a little bit, and we're going to put it up here, C-bond's done what it's supposed to do. It's had relatively low volatility, including last year. And in the 5-year chart that we have here, it's returned almost flat, so down 2%, plus you've gotten your yield every year. So, you're up in 5 years. So it's done what it's supposed to do. Whereas if you look at the equity market, and on this show, we've talked a lot about the large cap A share equities. Interesting about the large cap A share equities versus those high flying tech names. And those high flying tech names have offered you half the return on the upside and triple the losses on the downside. So you talk about volatility. On the upside, you go up less than 2 times, and on the downside, you go down more than 3 times versus the ASHR, which is the CSI 300. So what's the takeaway here? It's been rough sledding for 5 years, absolutely. But C-bond, fixed income, has done exactly what it's supposed to do. And on the equity side, volatility in those high-flying names, and I would say less volatility, not great returns in the large cap CSI 300 names.
I think whatever you mentioned, the advantages for the C bond, people understand that. So it's have a low volatility. It have quite a stable return. I think one concern to invest into C bond is due to the inflation. So due to the high inflation in China, if you invested, that's pretty much at the year end, you cannot beat the inflation. That's the major concern for the bond investors, unless they pursue like the low volatility or they try to part of the strategy. I think most of the guys, they still try to get a high volatility equity market. That's really they try to beat the inflation and share the uptrend of the equities. I think a majority is still like the mixed or asset allocation strategies, how to put them together.
Yep. That's what we've been talking about for as long as we've been doing this show, and I've been talking about it for a decade. I'm just hoping more people would listen. So we're going to leave it there. Get us in and out very quick this week for our Chinese New Year show. Thanks for tuning in, and we'll see you next week.
Thank you.